so lovely to see you again. I think the last time you were here with us at ABC Bullion was back in 2019.
Right.
Obviously, quite a bit has happened in the 5 to 6 years since. Maybe I might just get you to start with your overview of developments in precious metal markets over the last 5 years and how you see things right now.
Sure. Well, it's great to be with you, Jordan. It's great to be back. I've been coming to Australia since 1980 was my first visit. So, on and off for 45 years. You say a lot has happened in the last 5 years. I would say a lot has happened in the last 5 days. I mean, the news cycle just seems to keep speeding up. But the biggest single thing, of course, is the rally in the price of gold has it's more than doubled, actually tripled in the last couple of years. So the thing with gold, just in U.S. dollars, going from say $1,500 per ounce to $3,500 per ounce, which was the recent all-time high. That's a huge gain. But what really happened? Did the price of gold almost double, or did the dollar fall by half? You see, it's you have to decide what your metric is. I tend to think of gold by weight as my measuring stick. So when I see the price of gold double, more than double, which it has, exactly as we described, to me it's like, well, no, gold is gold. What really happened is the dollar has gone down significantly relative to gold. It's a weakening of the dollar. Now, the dollar has performed much better against other currencies. Recently, very recently, last 4 or 5 months, the dollar has gone down, the major indices, but that was from a fairly high level. It actually got quite strong against all the other major currencies. So people ask me all the time, they go, well, what's the dollar going to do? Is the dollar going to get stronger or weaker? And I answer their question with a question. I say, well, compared to what?
Sure.
What's your way of thinking about the value of the dollar? If you're talking about the euro or the yen or sterling or the Australian dollar and so forth, that's one question. And the short answer is I expect the dollar to get weaker against other major currencies. But if you're talking about gold, I would expect the opposite, that the price of gold would go up, which means that all the other currencies are falling even faster. So it's important to pick your yardstick. Pick, how do you actually measure the value of gold and so forth. But look, the U.S. dollar is the main measuring stick, and gold has done very well.
Interesting you mentioned the Australian dollar there. Obviously, it's not as big on the global stage as the euro or the yen or sterling and the like, but obviously of particular importance to Australian gold producers, Australian gold investors, including our clients at ABC Bullion. Mm-hmm. Do you have a particular view on where the Aussie will go versus the greenback, or how do you see that playing out between now and the end of the decade?
I would expect the Aussie dollar to get stronger relative to the U.S. dollar. But there's a very specific reason for that. There's a lot of buzz around the world of the BRICS are coming up with an alternative currency, and people are getting out of U.S. treasuries and losing confidence in the U.S. dollar. U.S. budget deficits are out of control. The U.S. debt is out of control, et cetera. And none of that is basically true. These are talking points, but they have to be put in a context. The U.S. debt, $37 trillion, that's a big number for sure. But you can't think about debt without comparing it to the resources. What is the GDP behind the debt? What are the assets on the other side of the balance sheet? And those kinds of things the Trump administration is talking about. And so one of the most influential advisors in the White House right now is Stephen Moran. He's an economist, but he wrote a paper last November on basically reconfiguring the entire global trading system. Pretty big claim. In there, he calls for something called the Mar-a-Lago Accord. And by the way, that was the title of Chapter 6 of my book, Aftermath, which came out in 2019, last time I was in Australia. So I'll take credit for coming up with the name. But his version of the Mar-a-Lago Accord looks at tariffs, trade, and exchange rate values, and kind of getting to your question, Jordan, about the Aussie dollar. Now, let's say I put 20% tariff on it. I'm the United States, and I put a 20% tariff on a trading partner. So some goods are, let's just say 100, it could be 100 million or whatever, but 100 as a measure, and I throw a 20% tariff on it. Now it's 120. But what if the trading partner devalues its currency by 15%? So it was at par, let's say hypothetically, and you drop it from 100 to 100 down to 85 to 100. Well, that negates the impact of the tariff, because yes, the tariff marks up the price, but if you're the producer and you can lower your local currency costs, your labor costs and so forth by devaluing your currency, you dilute the impact of the tariff. So what he is saying and indirectly what the White House is saying to U.S. trading partners is, we're going to put these tariffs on, so that's a given, but don't you dare devalue your currency.
Sure.
We're going to devalue the dollar. And any trading partner that tries to offset the tariffs by devaluing its currencies, there are going to be consequences to that. And he uses what I call the traffic light system. He says red, yellow, green in the U.S. That's traffic light. But he said we're going to divide U.S. trading partners into three categories. So green, you're a friend, you work with us, you know we've negotiated the tariffs, you accept the tariffs, and you accept the fact that we're going to devalue the dollar. Yellow, you're okay, you're not an enemy, but you're not our best friend, and you may suffer higher tariffs. Red, you're an adversary, clearly China and Russia. I think it's a mistake with Russia, but China and Russia would be in that category. You're going to get tariffs, if not sanctions, etc. But in addition, this is where it gets tricky. He injects national security considerations. Like, wait a second, this guy's an economic advisor, maybe a Fed governor, but what's he doing talking about national security? Sounds like Henry Kissinger. But he said, if you're in the green category, you will get the benefit of U.S. military protection. Sure. You'll get the nuclear umbrella and more. If you're yellow, we may work with you. And if you're red, you can expect that we'll be in an adversarial position. So the significance of that is he's putting military might and security guarantees behind his claims about the U.S. dollar and exchange rates. Now, that's only been done twice in U.S. history. One was between 1971 and 1974 when Richard Nixon closed the gold window. It suspended the ability of foreign trading partners to redeem dollars for gold. The second time this was done, where the goal was to devalue the dollar, was 1985. James Baker was Secretary of the Treasury. Ronald Reagan was president. But this Baker really took the lead on this. And using some of these indices I mentioned, the dollar was at an all-time high, and Baker said, no, it's not good enough. We have to devalue the dollar. So the dollar dropped about between 15 and 20%, depending on the cross rate at the time. So here's the third instance of the U.S. engineering a devalued dollar. This isn't the markets doing this. This is the U.S. Treasury insisting on it. So I look at the Aussie dollar, sterling, Swiss francs, euro, and say, you're all going to get stronger because the U.S. wants that. The U.S. is forcing that to happen and backing it up with some pretty nice rewards, carrots on the one hand, but a stick if not.
Jim, it would be impossible to talk about gold now without reflecting on the role that central banks are playing. We've seen enormous buying in the last 3 or 4 years in particular, but really it dates back to the global financial crisis almost 2 decades ago. Right. What's your view on the strength of that buying? Does it continue? Does it even maybe accelerate from here? How do you see that playing out between now and, say, 2030?
Well, you're exactly right, Jordan, about the central bank buying. And the turning point, you can actually chart this, was 2010, but right after the global financial crisis of 2008. From 1970 to 2010, central banks and finance ministries, sovereign wealth funds were net sellers of gold every single year. Beginning in 2010, central banks collectively became net buyers of gold. Russia has tripled, more than tripled its gold reserves from about 600 metric tons to almost 3,000 metric tons. I guess it's gone up closer to 5 times. Same thing with China, from about 600 metric tons to 3,000 metric tons. But we've also seen Japan go from 600 to 900 metric tons, etc. Kazakhstan, Vietnam, Philippines, Mexico, Turkey, Iran. Iran's not transparent, but they've been buying gold, etc. So you have this fairly large group of central banks who are buying gold. Where are the sellers going? So between 1970 and 1980, the U.S. sold 1,000 tons. We went from 9,000 metric tons to about 8,100, just a little over 8,000 metric tons. But the U.S. stopped cold. We never sold any gold after 1980. And there are reasons for that. Probably don't have time to go into them. They're highly technical. But so the U.S. has stopped selling gold. We're no longer a seller. We've just stopped at 8,133 metric tons. So the sellers went away. The buyers continued. They will continue going forward. And what's interesting from a gold investor's point of view, central banks and finance ministries are actually very smart buyers. They don't chase the market up. They buy the dips. I hate to use cliches, but they buy the dips. They put in just steady orders. They're not out to buy the whole everything they need at once. It'll be 20 tons a month, which Russia did. Central Bank of Russia was very transparent. By the way, just as a quick aside, Elvira Nabiullina is the head of the Central Bank of Russia. In my view, she's the only central banker in the world who actually understands her job. But she put 25% of Russia's reserves in physical gold stored in Russia between 2010 and 2022, which was the beginning of the war in Ukraine. So what did the U.S. do? Well, the U.S. and Europe froze $300 billion worth of U.S. Treasury securities that Russia had bought lawfully. They shipped oil, got dollars, bought Treasury securities, trusted the United States, which was, hindsight, turned out to be a mistake. So there are about 200 billion of Treasury security, Russian-owned Treasury securities in Euroclear. That's all been frozen. And the U.S. does it all the time. We're good at freezing things. But now they're stealing it. They're actually seizing it and using it and the interest on it as collateral for loans to Ukraine so that Ukraine can buy weapons to fight Russia. So Russia's own money is being used to fight Russia via Ukraine. But why hasn't Russia crumbled? Well, the answer is they had $150 billion in gold that the U.S. can't touch, can't freeze, can't seize. And that's one of the nice things about gold. It's not digital. I can't hack it. It's just there. Unless you want to pay Russia, which is a whole different thing. And one of the ironies is when the U.S. put all these sanctions on Russia, every sanction you can think of, they've failed. But one of the reasons was they had gold, and Russia has actually made $50 billion in mark-to-market profits on their gold reserves. So on the one hand, here we are stealing their Treasury securities, but by doing so, we're helping to create geopolitical risk, drive up the price of gold. And Russia has at this point, more than $50 billion profit on the gold. So kind of what goes around comes around. Now, here's the thing. From a gold investor's point of view, I like this. This is what is called an asymmetric trade, meaning with a central bank buy, you have a floor. It's not a hard floor. There's no guarantee, but you have a de facto floor under the price of gold, but you have unlimited upside. So you can buy gold with some confidence that it's not going to go down a lot because the central banks will just buy it. At the same time, the sky's the limit in terms of where it might go. So it makes gold a very attractive trade. I should be clear, we are not at the frenzy stage yet. This rally has a long way to go.
Jim, one final question for the day relates to silver. Obviously, we've talked a lot about gold so far. Most of the money that goes into precious metals does find its way into gold, but there is a very active and thriving market in silver. Yeah. We see that with our clients at ABC Bullion, and many of them are of the view that in a precious metal bull market, silver is likely to outperform gold. Do you subscribe to that theory, and what are some of the key drivers you see for silver going forward?
Silver is harder to analyze, and the reason is it is a precious metal, exactly as you described, Jordan, but it's also an industrial input. And so the price moves on both vectors. So as a precious metal, I do expect it to go higher. There's no way that gold is going to double or triple, and silver won't, be along for the ride. So you can see $100 silver at some point, and even higher from there. But at the same time, if we're going into a recession, which I expect we are, and manufacturing is declining, and everywhere from China and the U.S. as well, Europe, all over really, then there might be less demand on the industrial side. Although it's demand for electronics is still strong. So you've got sort of two forces. It's going to go up on the precious metals vector, but maybe lag a little bit in terms of the industrial input vector. But on net, I do expect silver to go up. I own a certain amount of gold, but I own a fair amount of silver also, and I buy American Silver Eagles from the U.S. Mint, 1 ounce coin. You get what we call a monster box. A monster box is 500 1 ounce American Silver Eagles, pure silver. That would be I'm trying to think. At this point, $15,000, $20,000. I'm not sure the exact price, but somewhere in that area.
Jim, thanks so much. Been exciting to catch up. We've obviously talked central bank demand. We've talked about developments in the gold space really since before the pandemic, the outlook for silver, some of the geopolitical and trade developments that are top of mind for precious metal investors today. Clients of ABC Bullion will be really excited to watch this video, and thank you again for coming in.
Thanks.